Imagine you're a rice farmer.
Okay.
And your entire livelihood is, currently planted in the ground. It's totally vulnerable to the elements. But surprisingly, the weather isn't actually what keeps you awake at night.
Right. It's the market.
Exactly. It's the price of rice. Because you know that if the market price just completely crashes right before you harvest, well, you are financially ruined.
Even if your crop is perfect.
Even if it's the best rice in the world. So to fix this anxiety, basically just to be able to sleep at night, you sit down with a local merchant and you write up a contract.
Makes sense.
You agree today on a set price for your rice, but it's for delivery, say, 3 months from now. And that single, totally desperate need for predictability in a chaotic world that is the seed.
The very beginning.
Yeah. And from that simple little rice paddy agreement, we have somehow grown this multi-trillion-dollar, hyper-complex global financial architecture.
And that is the architecture of derivatives, which, for the MBA student listening to us right now, the one who is currently staring down Chapter 14 of their Security Analysis and Portfolio Management textbook.
We feel your pain.
We really do.
Yeah.
But this is the exact architecture you need to essentially dismantle, understand, and then put back together in your head before you walk into your exam.
That's our mission for today's deep dive. We're going to absolutely conquer Chapter 14.
Together.
Right. We're bypassing the sort of rote memorization of, all that dense academic jargon.
Because that won't actually help you when the questions get tricky.
Exactly. Instead, we're focusing on the underlying mechanics. We want you to walk into that exam room, not just remembering the definitions, but fundamentally understanding the pure logic of options, futures, swaps, and the pricing models behind them.
Because if you understand why they exist, you can honestly derive the formulas yourself on the fly.
Yep. So don't panic. The entire system of derivatives, despite its terrible reputation for being impossibly complex, it's actually built on a very logical foundation.
It really is. It all comes down to a persistent underlying pattern. And that pattern is simply the shifting balance between rights and obligations.
Rights and obligations.
That's it. If you can track at any given moment who holds a right and who holds an obligation in a contract, the heaviest mathematics in this whole chapter they'll begin to feel intuitive.
I love that. Okay, so let's start right at the bedrock, the core foundation.
Yeah.
What actually is a derivative? Because the textbook gives us this very stark, undeniable starting point.
Right. A derivative has absolutely no intrinsic value of its own.
None.
Zero.
Which is wild to think about.
It is, which means you cannot hold a derivative, you can't weigh it or, assess its value in total isolation. Its entire financial existence is derived from an underlying asset.
Hence the name.
Exactly. And that asset could be physical, like our farmer's rice or barrels of crude oil, or it could be totally financial, like a specific company's shares or corporate debentures.
Or even something abstract, right?
Yeah, exactly, like a currency exchange rate or a broad market index like the S&P 500.
I always try to picture a derivative as a shadow.
Oh, I like that.
Yeah, because a shadow has no mass, right?
Yeah.
It has no physical weight. It only exists or moves or grows or shrinks because of the physical object that's casting it.
The underlying asset is the physical object.
Right, and the derivative is the shadow. So if the object moves, the shadow moves. If the object grows larger, the shadow stretches out.
That analogy tracks perfectly with how the textbook actually describes the pricing relationship. But for your exam, you also need to understand the historical context. Like, how did these shadows get so unimaginably large?
Right, because we started with a farmer.
Yeah. You mentioned the commodity hedging of the rice farmer, and that was the primary use case for literally centuries. But the text notes a massive seismic shift occurred in the 1970s.
Ah, the 70s.
This is the era when financial derivatives, meaning derivatives based on currencies, interest rates, and stocks, were truly introduced to the world and just began to explode in volume.
Which, if you look at macroeconomic history, that makes perfect sense.
Yeah.
I mean, we had the total collapse of the Bretton Woods system.
Right, the gold standard basically ending.
Exactly. So suddenly, global exchange rates weren't fixed anymore.
Yep.
They were floating and just fluctuating wildly every single day. And we had those massive oil shocks.
Leading to wildly unpredictable interest rates.
And soaring inflation.
Yeah.
The financial markets basically went from relatively stable to intensely volatile almost overnight.
And imagine you're a multinational corporation operating across borders during that time. You suddenly found yourself exposed to massive, unpredictable currency risks.
You could lose millions just because a currency moved 2% in a week.
Exactly. So corporate treasurers desperately needed tools to manage this totally new level of financial turbulence. And the market adapted. it created financial derivatives.
So necessity really was the mother of invention here.
It was. And the growth drivers listed in the text reflect that exact evolution. So it wasn't just increased volatility creating demand, it was the rapid acceleration of globalization.
Because more cross-border trade means more cross-border hedging.
Right. And it was also the development of more sophisticated risk management software. Computers finally allowed us to actually price these incredibly complex things. Today, the text notes that financial derivatives account for a staggering 1/3 of all derivative products.
Wow. Okay, so setting the history aside for a second, the exam is definitely going to test you on the legal framework.
Oh, absolutely.
Especially if you're in India, equity derivatives are strictly defined under the Securities Contract Regulation Act of 1956.
The SCRA.
Yes, the SCRA. And this is one of those definitions you should just have locked in your memory for a short answer question. So the Act defines a derivative as, quote, a security derived from a debt instrument, share, loan, whether secured or unsecured, risk instrument or contract, or any other form of security, end quote.
Now notice the phrasing there, a security derived from. It reinforces your whole shadow concept perfectly,
Right.
but it casts a very, very wide net. It's not just derived from shares of stock. It can be derived from a loan. It can be derived from another risk instrument, which means you can literally have a derivative of a derivative.
A shadow of a shadow.
Exactly. The legal definition is intentionally broad just to encompass the sheer flexibility of these contracts.
Okay, so to really nail down the foundational characteristics, a textbook outlines 6 salient features of derivative instruments. Let's look at the mechanics behind each one because, I mean, this is prime material for a multiple choice section.
It really is.
Feature 1. They can be traded on stock exchanges, which provides liquidity.
Yeah.
You can enter and exit positions quickly because it's a centralized marketplace.
Right. Feature 2. They have low transaction costs compared to, say, buying the underlying asset outright.
Feature 3 is the mathematical tether we talked about. There is a close relation between the value of the derivative and the value of the underlying asset.
Feature 4 simply states they possess unique characteristics not common to other assets, which we are going to explore deeply when we get to options in a minute.
And skipping to feature 6, it points to their adaptability. They can be custom-tailored or combined to meet very, very specific portfolio requirements.
But you skipped 5.
I did skip 5
Yeah.
because I want to spend some serious time on feature number 5. It is incredibly counterintuitive, and it's a massive trap for students on an exam.
Oh, the credit risk one.
Yes. Feature 5 literally states,
Yeah.
derivatives have low credit risk because the margin requirements for exchange-traded derivatives are low. Now, when you hear the word derivatives, you naturally think of massive risk. You think of like the 2008 financial crisis. So how on earth does the textbook justify calling them low credit risk?
Okay, the key to unlocking this, for everyone listening, is understanding that in finance, the word risk is not a monolith.
Meaning there are different flavors of risk.
Exactly. The textbook is drawing a very hard line between 2 totally distinct types of risk: market risk and credit risk. When you hear stories on the news of rogue traders losing millions on a derivatives bet gone wrong, they are falling victim to market risk.
Because the price moved against them.
Right. The price of the underlying asset moved aggressively against their position. They took a bet on the direction of the market and they lost. That is market risk.
But credit risk is a completely different beast entirely.
Completely different. Credit risk has absolutely nothing to do with the fluctuating price of the asset. Credit risk is simply the danger that the person on the exact opposite side of your trade, your counterparty, goes bankrupt, disappears, or just outright refuses to pay you the money you are legally owed.
So you could make a brilliant trade. The market could move exactly as you predicted.
Yes,
But if your counterparty defaults, your theoretical profit just vanishes.
it's gone. So if I make a private bet with an unreliable friend that the price of oil will go up.
Your market risk is the price of oil itself.
Right. But my credit risk is whether my friend actually has the cash in his wallet when I win the bet.
That makes total sense.
And this is where the genius of the stock exchange comes in. Because for exchange-traded derivatives, you aren't actually relying on an unreliable friend. The exchange itself steps in and effectively becomes the counterparty to every single trade.
Which is amazing.
It is. And to guarantee that absolutely no one defaults, the exchange forces every single participant to deposit margins, essentially a cash security deposit up front.
Right.
So because the exchange is holding this collateral and they are heavily regulating the participants, the risk of a counterparty default is mathematically squashed. Hence, derivatives have high market risk but exceptionally low credit risk.
That is such a crucial distinction. Exchange-traded means regulated margins, which means low credit risk. Keep that in your back pocket for the exam, guys.
Definitely.
Okay, so now that we have the foundation laid, we know what a derivative is, we know its legal definition, and we understand its features, we are totally ready to step into the first major category of derivatives, the realm of options.
This is it. This is where we encounter what might be the most important sentence in Chapter 14, the definition of an option contract.
Lay on us.
An option is a contractual agreement between two parties that gives the buyer the right, but not the obligation, to purchase or to sell a specified instrument at a specified price at any time of the buyer's choosing by or before a fixed date in the future.
The right, but not the obligation. If you're taking notes, I would underline that, highlight it, and circle it in red ink. Everything we are about to discuss hinges on that specific phrasing. The buyer of an option is purchasing power. They are purchasing a choice.
Exactly. And as a direct consequence of that choice, we have to look at the second half of the definition. Upon the exercising of the right by the option holder, the buyer, the seller, is thereby obliged to deliver the specified instrument at the specified price.
So it's a totally asymmetrical relationship.
Completely.
Like if I buy an option from you, I am holding all the cards. I can choose to exercise the contract, or, I can just choose to walk away and do nothing. But if you sell me that option, you have chained yourself to my decision.
I'm stuck.
Right. If I decide to exercise my right, you have absolutely no choice. You must comply with the terms of the contract, no matter how much money you personally lose in the process.
And because of this extreme asymmetry, the stock exchange heavily regulates option contracts just to maintain market stability. The exchange dictates the standardized lot size, what the underlying asset actually is, the strike dates, the expiration dates, and the margin requirements.
And this asymmetry also dictates the unique features of an option. For the buyer, their liability is strictly limited. The maximum amount they can lose is just the money they paid to buy the option in the first place.
Nothing more.
Plus, and this is important, just because you buy an option on a company's stock, it does not mean you own the stock. You get no voting rights at shareholder meetings, you don't collect any dividends, you own a contract, not a piece of the company.
That's a great point. Now, before we start calculating profits and losses, we really need to master the vocabulary.
9 key terms.
Yes. The textbook lists 9 key terms used in options contracts. And understanding these isn't just about passing of a vocabulary quiz. These are the actual variables you're going to plug into every single pricing formula later on. So let's break them down. Term 1, strike price.
Okay, also known as the exercise price. The strike price is the fixed price at which the option may be exercised. It's basically the line in the sand you draw today for a transaction that might happen in the future.
Right.
So if we agree on a strike price of 100 rupees, it honestly doesn't matter if the market price goes down to 10 or shoots up to 1,000. Our contract executes at exactly 100.
Spot on. Term 2, premium. This is the upfront cost. It is the price paid by the buyer to the seller on the date the contract is mutually decided.
I always frame the premium as the cost of admission. You are paying for the privilege of having that right, but not the obligation. The seller is taking on a massive potential burden by giving you that choice, so they demand to be compensated up front. And that compensation is the premium.
Exactly. Now, term 3 categorizes the timing of the choice. American option versus European option.
Okay, students, listen up. You must separate these from geographic locations in your mind. This has nothing to do with where you live.
Nothing at all. This is purely about execution mechanics. In an American option, the buyer has the right to exercise their option at any point in time prior to the expiration date. It offers maximum flexibility.
So if I hold an American option that expires in 3 months and the market moves in my favor tomorrow, I can exercise it tomorrow. I don't have to wait.
Right. But contrast that with a European option. A European option aggressively restricts the buyer's right. The buyer can only exercise the option on the actual expiration date itself.
So if the market moves in your favor tomorrow, but the expiration isn't for 3 months, you're just stuck waiting.
You must wait. Term 4, expiration. This is simply the ticking clock. It's the date after which the option ceases to exist. If you don't exercise your right by this date, the contract dies and your premium is just gone forever.
Term 5. Okay, term 5 is the margin deposit, and this is where our earlier discussion about risk comes rushing back into play. The text defines this as an initial margin required by the exchange to protect against defaults. But here's the critical insight for the student, and it's a huge aha moment. Only the seller of the option is required to pay this margin deposit. The buyer pays zero margin.
This is a point that trips up a lot of people on exams.
Right. Because you think, why wouldn't the exchange demand a security deposit from both sides just to be safe?
It goes back entirely to that asymmetry we talked about. Think about it. The buyer pays the premium up front. Once that premium leaves their account, they have zero further financial obligations.
Because they hold a right, not an obligation.
Precisely. It is literally mathematically impossible for the buyer to default on a future payment because they simply don't owe any future payments. They can't default.
Wow. Okay.
But the seller, on the other hand, has collected the premium, but they have taken on an open-ended obligation. If the market swings wildly, the seller might suddenly be forced to produce a massive amount of capital to fulfill the contract. Because the seller is the only party capable of defaulting, the exchange only needs a margin deposit from the seller.
It is such a highly efficient allocation of risk management. That is a beautiful piece of financial logic.
It really is elegant.
Okay, moving through the rest of the vocabulary. Term 6, declaration day. This is basically the deadline for the buyer. It's usually the second to last day in the account period where the buyer must formally declare to the exchange if they are actually going to claim their rights or just let the option expire.
Term 7, traded options. This simply refers to options that are standardized and publicly traded on organized stock exchanges, ensuring high flexibility and transferability as opposed to, private customized agreements between two people.
Term 8, double options. This is a weird one. It's a hybrid instrument. A double option gives the holder the right either to buy ORR to sell the underlying shares at the strike price.
You are essentially hedging both directions.
Right. The strike price is usually set right around the current market, quote. But because you are demanding double the flexibility from the seller, the text explicitly notes that the option money, meaning the premium, is twice the quoted price of a standard single-direction option.
Naturally. You pay for the extra privilege. And finally, term 9, gearing. Understanding gearing is basically understanding the primary psychological appeal of options trading.
Oh, yeah.
Gearing refers to leverage. The textbook notes that while risk is higher, the rewards are equally higher in relation to the initial amount invested. The percentage price movements of an option are vastly magnified compared to the underlying asset.
Let's put some hard numbers to gearing so it really sticks for the exam, because it sounds abstract until you do the math.
Let's do it.
Okay, let's say a stock costs 100 rupees. You have 100 rupees in your pocket, so you buy exactly one share. The stock goes up to 110 rupees.
Right.
Great. You just made a 10 rupee profit on a 100 rupee investment.
That is a 10% return.
Solid, but, not life-changing. Now let's use gearing. Instead of buying the physical stock, you use your 100 rupees to buy options. Let's say the premium for an option is just 2 rupees. For your 100 rupees, you can now buy 50 options. If the stock moves exactly the same way up 10 rupees, each of your 50 options captures that 10 rupee move. You just made 500 rupees.
Wow.
Right. Your initial 100 rupee investment generated a 500% return, all from the exact same underlying market movement. You used a very small amount of money to control a massive amount of the underlying asset. That is the lever of gearing.
But the danger, of course, is that the lever works in reverse just as fast.
Oh, absolutely.
If the stock drops even slightly below your strike price, your option just expires worthless. You don't just lose a small percentage, you lose 100% of your initial investment.
Oof, gone.
Gone, which perfectly sets the stage for us to actually look at the exact mechanic of how these payouts work. We are going to analyze calls, puts, and the concept of moneyness.
Let's start with the call option. A call option is buying the right to BUI. The textbook defines it as a contract, providing the right to buy specified shares on or before a specified date at the strike price. And the seller of this contract is known as the writer.
Right. To prepare for the math portion of the exam, we really should dissect the textbook's illustration for Wipro Limited.
Let's do it.
Imagine an investor purchases one call option on Wipro stock. The agreed-upon strike price is 55 rupees. The premium paid up front to the writer is 3 rupees per share.
A quick note for the listeners who are literally following along in the actual textbook right now. The paragraph text accidentally mentions a premium of 2 rupees, but the corresponding data table right below it uses 3 rupees.
Classic textbook quirk.
Right. We're going to stick with the 3 rupee premium because that's what makes the table's math actually work out. So you have the right to buy Wipro at 55, and you paid 3 rupees for this, right?
Exactly. So the fundamental formula for a buyer's payoff in a call option is the maximum of either spot price minus strike price or 0.
Wait, what is spot price again?
Spot price is simply the current market price right now.
Got it.
So let's run a scenario from that table. What happens if the spot price of Wipro drops to 50 rupees?
Okay. We apply the logic of the right, but not the obligation. The open market is currently offering Wipro at 50. My contract gives me the right to buy it at 55. I would be a total fool to exercise my right and voluntarily pay 55 for something I can just go get for 50.
Obviously.
So I do nothing. I abandon the option. The payoff from the contract is 0. But I am still out the 3 rupee premium I paid up front. So my net profit is a loss of 3 rupees.
Precisely. Your loss is strictly capped at the premium. Now, let's look at the other end of the spectrum. The stock market surges, and Wipro's spot price hits 67 rupees.
Oh, now the contract is highly valuable. I hold a piece of paper that legally forces the writer to sell me Wipro for 55, even though everyone else in the world is paying 67.
So you exercise.
I absolutely exercise my right. So spot, which is 67, minus strike, which is 55, equals a payoff of 12 rupees.
But we must calculate net profit. You received a 12 rupee payoff, but you must deduct your initial cost of admission.
Right, the premium. So 12 minus my 3 rupee premium leaves me with a net profit of 9 rupees. I risked 3 rupees to make 9 rupees. That's a 300% return on investment.
Now let's flip the entire structure upside down and look at the put option. A put option is buying the right to sell. The buyer gets the right, but not the obligation, to sell a given quantity of an underlying asset at a given price.
So if a call is an aggressive bet that the market will go up, a put is basically a bet that the market will crash, or I guess it's used as an insurance policy to protect a portfolio you already own against a sudden downturn.
Exactly. The textbook uses an illustration for Reliance Limited to demonstrate this. An investor buys a put option on Reliance. The strike price is set at 55 rupees. The premium paid is 3 rupees.
Because the goal here is inverted, the payoff formula inverts as well. For a put, the payoff is the maximum of either strike price minus spot price or 0.
Let's test the logic again. The stock price of Reliance jumps up to 68 rupees.
Okay, I have the right to sell my shares to the writer for 55, but the open market is willing to pay me 68. Obviously, I will ignore my option and just sell on the open market. I do not exercise. The payoff is 0, and I lose my 3 rupee premium.
But what if the market collapses and Reliance drops to 45 rupees?
This is where that insurance kicks in. The open market will only give me 45, but my contract forces the writer to buy it from me for 55. So strike 55 minus spot 45 gives me a payoff of 10 rupees. I subtract my 3 rupee premium, leaving a net profit of 7 rupees.
And these scenarios lead directly into standard industry terminology regarding the status of an option at any given moment. The textbook introduces the concept of moneyness using 3 critical acronyms. You need to know these: ATM, ITM, and OTM.
At the money, in the money, and out of the money.
Yes. For a call option, you're right to buy. If the strike price is exactly equal to the current market price, the option is ATM, at the money. There is no intrinsic profit to be made quite yet.
Yeah.
If the strike price is less than the market price, your option is ITM, in the money. You could exercise it right now for a guaranteed profit. And if the strike price is greater than the market price, it is OTM, out of the money. Exercising it would actually result in a loss.
And because a put option is the right to sell, the ITM and OTM definitions are just completely reversed. ATM is still when they are equal. But for a put, it is ITM, in the money, when the strike price is greater than the market price. But you can sell it for more than it's worth.
Exactly.
And it is OTM, out of the money, when the strike price is LSS than the market price.
Understanding moneyness is essential for the exam because it dictates how an option is valued before the expiration date. An option's total value, or its premium in the open market, is comprised of 2 distinct components: intrinsic value and time value.
Okay, intrinsic value is the mathematical reality of the present moment. It is strictly the tangible difference between the spot price and the strike price right now. But here's a trick for the exam. Intrinsic value only exists if the option is in the money.
Right.
If an option is out of the money, the intrinsic value doesn't become a negative number, it just bottoms out at 0.
Which raises an incredibly interesting question. If an option is out of the money and its intrinsic value is absolutely 0, why would anyone pay money to buy it? Why do OTM options still have a premium?
Because of the second component, time value.
Yes, they have a premium because of time value.
Time value is essentially the premium you pay for the unknown future. It is the excess of the market price of an option over its intrinsic value. As long as there is time left on the clock before expiration, there is a statistical probability that the stock could move wildly in your favor.
Time value is essentially the price of volatility combined with duration. The writer of the option demands to be compensated for taking on the huge risk of the unknown over that specific time period. The buyer pays the time value, hoping that the future will eventually transform their OTM option into an ITM option.
Which brings us to one of the absolute most critical sections for the exam. The textbook provides this comprehensive grid titled Parameters of Option Value and its Impact on the Option Prices.
Yes, well, you know the grid.
Yeah, that grid maps out 6 parameters and dictates whether an increase in each parameter has a favorable impact, meaning it increases the price of the option, or an adverse impact, meaning it decreases the price. We really need to go through all 6 and understand the why behind each one instead of just memorizing the letters.
Okay, let's do it. Parameter 1 is the spot price of the underlying asset. As the spot price increases, the right to buy at a fixed price obviously becomes more valuable. Therefore, a rising spot price is favorable for a call option.
Makes sense.
Conversely, the right to sell at a fixed price becomes less valuable as the asset gets more expensive. So a rising spot price is adverse for a put option.
Parameter 2 is the strike price. This is basically the hurdle you have to clear. The higher the strike price, the harder it is for a call option to ever become profitable. So a higher strike price is adverse for a call.
Right.
But for a put option, a higher strike price means you get to sell the asset for a higher amount. Therefore, it is favorable for a put.
Parameter 3 is the time to expiration. More time simply equals more opportunity for the asset to move favorably. Whether you hold a call or a put, more time provides a wider cone of probability. Therefore, an increase in time to expiration is universally favorable for both European calls and puts.
Parameter 4 is volatility. Now, this is where financial engineering gets really fascinating, and honestly, where intuition often fails students.
Disgustingly.
The grid shows that an increase in volatility is favorable for both calls and puts. But wait, in traditional finance, volatility is completely synonymous with risk.
Right, a highly volatile stock is considered a dangerous stock.
Exactly. So why would high volatility make an option more valuable?
To understand this, you must recall the extreme asymmetry we discussed at the very beginning. Remember, the buyer's downside is strictly capped. You can never, ever lose more than the premium you paid.
Right.
If you buy a call option and the stock becomes wildly volatile and just crashes all the way to zero, you don't lose the value of the stock, you just lose your tiny 3 rupee premium. Your loss profile is entirely flat.
But my upside is a straight diagonal lineup.
Exactly. Your upside is theoretically unlimited. Because your downside is walled off by the contract, but your upside is entirely open to the sky, you actually want the stock to swing wildly. High volatility significantly increases the statistical probability of a massive payout, while your maximum potential loss remains rigidly fixed at 3 rupees. Therefore, higher volatility always increases the value of the option.
That is such a vital concept to grasp. You are essentially buying the right to capture the upside of chaos while entirely ignoring the downside.
Beautifully put.
Okay, parameter 5 gets a bit tricky. Risk-free interest rates. The grid shows that rising interest rates are favorable for calls and adverse for puts. Let's unpack the mechanics of why that happens.
It all comes down to the concept of the cost of carry and the time value of money. When you buy a call option, you are securing the right to buy the stock later rather than buying it today. This means you get to hold on to your cash right now.
And cash is not a dead asset.
Correct. You can take that cash and put it in a bank, earning the risk-free interest rate. If interest rates go up, the value of holding on to your cash actually increases. Therefore, the strategy of buying a call option, which allows you to delay payment and earn interest, becomes way more attractive, which drives the price of the call up. Favorable.
But for a put option, the logic totally reverses. A put option is the right to sell the stock and receive cash later. If interest rates are high, you want cash in your hands now so you can start earning that high interest. A put option basically forces you to wait to get your cash. The higher the interest rate, the more it hurts you to wait. Therefore, rising rates make put options less attractive. Adverse.
That is an excellent breakdown. The 6th and final parameter is dividends. The impact here is adverse for calls and favorable for puts. And this relates entirely to how dividends affect the underlying spot price.
Right. When a company pays out a dividend, cash literally leaves the company's balance sheet and goes into the pockets of the shareholders. Because the company now has less cash, the mathematical value of the company actually drops and the stock price drops on the ex-dividend date.
It mathematically has to.
And since we already established that a dropping stock price is bad for a call option, dividends are adverse for calls. And since a dropping stock price is great for a put option, dividends are favorable for puts.
Understanding the underlying logic of those 6 parameters, spot, strike, time, volatility, interest rates, and dividends, is the absolute prerequisite for the next stage of our deep dive.
Yes, because knowing the variables is one thing. But how do modern financial institutions actually synthesize all these moving variables to calculate a precise premium down to the decimal?
This brings us to the complex mathematical engines of the market. Option pricing models.
The textbook focuses heavily on 2 primary models. The first is arguably the most famous equation in all of modern finance. It's a model that literally revolutionized Wall Street and won a Nobel Prize, the Black-Scholes model.
Developed by Fisher Black and Myron Scholes, this model provides a continuous analytical formula to calculate the theoretical price of a call option. It takes 5 of the specific determinants we just discussed: current stock price, strike price, volatility, time to expiration, and the risk-free interest rate, and it processes them through a deeply complex equation involving natural logarithms, exponential functions, and cumulative standard normal distributions.
And the formula in the text is incredibly intimidating. Calculating D1 and D2 using the natural log of S0 over E plus the risk-free rate plus half the variance all over the standard deviation times the square root of time.
It's a mouthful.
It is. Now, for the exam, depending on your professor, you may or may not have to manually calculate the formula, but you absolutely 100% need to know the assumptions that the formula relies upon, because the formula only works if you agree to its specific rules.
The textbook explicitly lists 7 strict assumptions required for the Black-Scholes model to function. Assumption 1. It is designed specifically for a European option, meaning it assumes the option can only be exercised at maturity.
Okay.
Assumption 2. There is a complete absence of transaction costs. Assumption 3. There is a complete absence of taxation. Assumption 4. There are no restrictions whatsoever on short selling.
Assumption 5. The model assumes that stock prices follow a log normal distribution, meaning returns are normally distributed. Assumption 6. The model assumes the underlying stock will pay absolutely no dividends during the life of the option. And Assumption 7. The risk-free interest rate is known and remains perfectly constant throughout the life of the contract.
Now, if you look closely at those 7 assumptions, a pretty glaring issue becomes apparent.
The issue is that the universe Black-Scholes describes simply does not exist.
It really doesn't.
It assumes a perfectly frictionless vacuum. In the real world, there are always transaction costs. The government always takes its taxes, stocks definitely pay dividends, and interest rates fluctuate constantly. So a student might reasonably ask, why is the most famous model in finance based on a total fantasy?
It is a profound question. The defense of Black-Scholes is that the theoretical constraints are a necessary abstraction to isolate the core mathematical truths. By temporarily stripping away the friction of taxes, dividends, and rate changes, Black and Scholes were able to isolate the pure, raw relationship between time, volatility, and price. It provides an objective mathematical baseline.
It's like a physics equation that starts with assume a spherical cow in a vacuum.
Yes.
It's not reality, but you have to start with the vacuum to figure out the basic gravity before you can add the air resistance back in. In the real world, traders take the Black-Scholes baseline and use advanced software to tweak it, adding the friction back in to account for American-style early exercise or expected dividends.
Let's look at how the model translates to an actual payoff matrix. The textbook provides an illustration for a Hindalco put option. It models a 90-day put option with a strike price of 510 rupees, while the current stock price is 450 rupees. The model calculates a theoretical premium of 74.8 rupees.
Now, if you are looking at the Hindalco table in your book right now, I need you to grab a red pen and draw a massive warning circle around it. This table is a classic trap for students who are just rushing through the material.
So true.
The table maps out the gains based on different potential stock prices. But if you look at the math, it shows that if the stock price drops to 350 rupees, the gain is listed as negative 85.2.
Which should instantly trigger an alarm in your head. We established earlier that a put option is the right to sell. You want the stock to drop.
Right.
If the stock drops from 450 to 350, a put option buyer should be making a massive, massive profit. So why is the table showing a negative number?
Because the textbook subtly switched perspectives without announcing it. This entire Hindalco table is written from the perspective of the seller, the writer of the put option.
Let's walk through it just to prove it. If you are the seller, you collected the 74.8 rupee premium up front. If the stock crashes to 350, the buyer basically forces you to buy their stock for the 510 rupee strike price.
Ouch.
Yeah, you are forced to pay 510 for an asset that's only worth 350 on the open market. That is a brutal loss of 160 rupees. But because you collected the 74.8 premium initially, your net mathematical loss is mitigated down to 85.2, hence the negative number in the table.
And you look at the bottom of the table. If the stock goes up to 550, the buyer doesn't exercise. The seller's payoff is 0, but their total gain is listed as a positive 74.8. They get to keep the premium as pure profit.
Yeah.
Just be deeply, deeply aware of whose perspective a textbook table is using on the exam.
Definitely.
Okay, so Black-Scholes is the continuous, frictionless model. What is the second model?
The binomial model, developed by Cox, Ross, and Rubinstein, where Black-Scholes uses a single continuous analytical formula. The binomial model breaks the time and expiration down into discrete, manageable intervals. It utilizes a visual framework known as a binomial tree.
A binomial tree basically models a series of branching pathways. Instead of trying to predict the final destination in one massive calculation, it simulates steps. Let's say a stock is at 100 rupees today. The model looks 1 day or 1 week into the future. It calculates a specific probability that the stock will move up to, say, 110, and a specific probability that it will move down to 90.
From those two new potential nodes, 110 and 90, it branches out again for the next time step. The 110 could go up to 121 or down to 99. The 90 could go up to 99 or down to 81. As you map this out over dozens or hundreds of intervals, you generate a massive branching tree of all possible future price pathways until you finally reach the expiration date.
But creating a giant tree of futures doesn't give me a price today. The text states the binomial model arrives at today's premium by using backward induction. What exactly is backward induction?
Backward induction is the process of solving the tree in reverse. Once you build the tree all the way out to the expiration date, the option's value at those final outermost nodes is absolute. There is no more time value. There's only intrinsic value. You know exactly what the option is worth at the very end.
Okay, I follow.
So the model takes those final certain values and works backward one step at a time. It calculates the weighted average probability of the up and down nodes, discounts that value by the risk-free rate for that single step, and assigns a value to the preceding node. It iteratively folds the tree back on itself step by step until it arrives all the way back at the single node of the present day, yielding the current premium.
Wow. Okay, so for your exam, a very common essay question is to just compare and contrast these two models. Let's build a clear 3-point comparison for the listeners.
Point 1 involves the computational structure. Black-Scholes is a closed-form analytical equation. It is incredibly fast and efficient for computers to process instantly. The binomial model is an iterative numerical method. Building and solving massive trees requires significantly more computational power and time.
Point 2 centers on the style of the option. Black-Scholes is designed fundamentally for European options because its continuous formula is aimed directly at the final expiration date. The binomial model, however, is much better suited for American options.
Because it maps out discrete steps.
Right. Because it maps out discrete steps, the software can pause at every single node on the tree and ask, is the intrinsic value of exercising the option early at this specific node greater than the discounted expected value of holding on to it? It can actually map the optimal early exercise strategy.
Point 3 is flexibility. Black-Scholes is rigid. It requires those 7 assumptions we discussed, like constant interest rates and volatility. The binomial model is highly adaptable. Because it calculates step by step, you can literally program the tree to change the interest rate or alter the volatility assumption midway through the life of the option to reflect a scheduled dividend payment or an upcoming earnings report.
So Black-Scholes is like a streamlined, frictionless bullet. The binomial tree is a complex, all-terrain vehicle that comprehensively covers the realm of options.
It does.
But as we transition out of this section, we really must execute a critical psychological shift. We are leaving the land of choice. We are leaving the realm of rights without obligations and entering a space where commitments are absolute. We are diving into futures and forwards.
Yes. In a futures or forward contract, There are no premiums paid for flexibility. The textbook defines it clearly. It is an agreement between two parties to buy or sell an asset at a certain time at a certain price in the future. The crucial distinction is that it is a firm, inescapable obligation for both parties.
You are shaking hands and saying, I will buy this asset from you in 3 months for 100 rupees. I don't care if the market price drops to 10 rupees. I am legally obligated to buy it from you for 100.
Exactly.
Now, while forwards and futures sound identical in purpose, their execution mechanics are radically different. The textbook provides a comprehensive comparison table that we need to dissect, as this is a very frequent source of exam questions.
The primary difference, from which all other differences cascade, is the venue of the trade. Forward contracts are negotiated privately between two individual parties. They are traded over the counter, or OTC. They are not listed on any organized exchange.
Because they are private, bilateral agreements, the contract specifications are entirely custom. They are tailor-made. If I want a forward contract for exactly 4,321 kilograms of a very specific grade of basmati rice to be delivered on a Tuesday at noon to my specific warehouse, I can negotiate that with the supplier.
But that level of customization comes with severe drawbacks. The most glaring is counterparty risk, which we discussed earlier. In a private forward contract, if the market moves violently against the supplier and they go bankrupt, or simply refuse to deliver the rice, you are left holding a worthless piece of paper. You have to take them to court.
Which leads to the other drawback. Low liquidity. Because my contract is so bizarrely specific, it is nearly impossible for me to sell that contract to a third party if I want to exit the trade early. No one else wants my highly specific terms.
Now, contrast all of that with a futures contract. A futures contract achieves the exact same economic goal, locking in a future price, but it is traded on a regulated stock exchange. Therefore, the contracts are highly standardized. The exchange dictates the exact quantity, the acceptable quality grades, the specific delivery months, and the quotation units.
You lose the ability to customize, but you gain immense liquidity. Because every contract is identical, you can buy and sell them in milliseconds on the open market.
Sure.
And most importantly, because it is on an exchange, you totally eliminate counterparty risk. This is achieved through an institution that is honestly, arguably the unsung hero of the global financial system, the clearinghouse.
The clearinghouse is a fascinating mechanism. In a private forward contract, the buyer and seller are directly linked. But in a futures market, the moment a trade is agreed upon, the clearinghouse steps right in between them. Through a legal process called novation, the clearinghouse actually becomes the counterparty to both sides. It becomes the legal seller to every buyer and the legal buyer to every seller.
It totally severs the link between the two original traders. I don't need to worry about whether the guy who originally sold me the futures contract is going bankrupt because he doesn't owe me anything anymore. The massive, heavily capitalized clearinghouse owes me. It is an impenetrable financial buffer zone that guarantees performance.
But the clearinghouse isn't operating on blind faith. To protect itself, it enforces a rigid system of daily accountability known as mark-to-market settlement. This is another fundamental difference. Forward contracts generally settle entirely on a single date, the maturity date. You don't realize any cash gains or losses until the very end.
Futures settle every single day. Mark-to-market means that at the end of trading, the exchange looks at the official closing price. It then calculates exactly who gained value and who lost value that day. And that very night, the exchange reaches into the loser's accounts, pulls the cash out, and drops it directly into the winner's accounts. You are settling your debts on a daily cycle.
And this daily settlement is entirely dependent on the mechanics of margins. To trade futures, participants must post collateral. The textbook details 3 distinct types of margins that interact to keep the system solvent: initial margin, maintenance margin, and variation margin.
Understanding how these 3 interact is best done through an analogy, I think. Let's use the process of renting an apartment.
Perfect. Let's apply it. The first requirement is the initial margin. This is a percentage of the total contract value. The text notes it usually ranges between 5% and 25% that both the buyer and the seller must deposit with the broker before they are even allowed to initiate a trade.
This is your security deposit. Before the landlord hands you the keys to the apartment, you have to write a check to prove you have skin in the game. You can't even enter the market without the initial margin.
Once you are in the trade, the daily mark-to-market process begins. If the market moves against you, money is deducted from your margin account. This is where the maintenance margin comes in. It is a set threshold lower than the initial margin, representing the absolute minimum balance you must maintain in your account at all times.
Continuing the analogy, think of the maintenance margin like a minimum balance requirement on a premium bank account. The bank says you must keep at least $1,000 in the account. Your balance can fluctuate every day, $1,500, $1,200, $1,050, and that's totally fine. But the moment it dips to $999, alarms go off.
If your account balance falls below that maintenance threshold due to consecutive daily losses, the exchange issues a margin call. You are now legally required to immediately deposit fresh funds to bring your account balance all the way back up to the original initial margin level. This top-up amount is known as the variation margin.
This is the dramatic part. The variation margin is when you accidentally throw a baseball through the window of your rented apartment. The landlord doesn't just deduct it from your security deposit and let it ride. The landlord calls you and says, "You breached the threshold. Wire me the cash to replace the window immediately so my security deposit is whole again, or I am evicting you today."
And they mean it.
Oh yeah. If you fail to meet a margin call, the broker will automatically liquidate your position in the market to stop the bleeding.
It is a ruthless, highly effective system for preventing systemic debt accumulation. A final mechanical concept to note in futures is the time spread. This refers to the price relationship between the spot market and the futures market, or the difference in price between two futures contracts on the exact same asset but with different expiration months. Analyzing time spreads allows traders to assess the actual cost of carrying an asset over time.
Now, we've talked about futures primarily using physical commodities as examples, like the rice. But the vast majority of the market's volume is not in wheat or copper, it's in financial instruments. This brings us to index futures and market participants. People are essentially trading the macroeconomic trajectory of entire countries.
An index future uses a stock market index as its underlying asset. A stock index is a weighted mathematical construct that represents the general price levels of a specific basket of stocks, acting as a barometer for a sector or an entire economy.
The textbook lists the major global indices you should definitely recognize. In India, the BSE Sensex and the NSE CNX Nifty. In the US, the Dow Jones Industrial Average, the S&P 500, and the tech-heavy Nasdaq Q100. In the UK, the FTSE 100. In Japan, the Nikkei, and in Germany, the DAX.
A critical mechanical distinction of index futures is settlement. With a commodity future, you could theoretically take physical delivery of a train car full of grain. With an index future, physical delivery is physically and legally impossible. You cannot deliver a fractional basket of 500 different underlying stocks in their exact weighted proportions. Therefore, index futures mandate cash settlement exclusively. The final difference between the contract price and the closing index price is simply wired between accounts.
So how do we determine the fair price of an index future today, given that it's just a mathematical projection? The text provides a specific valuation formula. For the exam, lock this into your memory. F sub B equals I sub B plus, in parentheses R sub F minus D.
Let's translate the variables. F sub B is the theoretical futures price today. It equals I sub B, which is the current spot index price, plus the risk-free interest rate, that's R sub F over the life of the contract, minus the expected dividends, that's D, from the index stocks over that same period.
To really understand this, we have to ask why we add the interest rate and subtract the dividends. Let's look at it through the lens of arbitrage. Why is the risk-free rate added to the current index price?
It's the cost of carry model all over again. If you want exposure to the S&P 500, you essentially have two choices. Choice A, you buy all 500 physical stocks today. That requires massive capital out of your pocket right now. Okay. Choice B, you buy an S&P 500 index future. This only requires a small margin deposit, meaning you get to keep the rest of your massive capital in the bank, earning the risk-free interest rate. Because choice B gives you the exact same market exposure plus the benefit of earning interest on your retained cash, the market simply must price the future higher to eliminate that free advantage. Therefore, we add the risk-free rate to the spot price.
That balances the scale. But then, why do we subtract the dividends? If I'm buying a derivative based on the stock market, shouldn't I benefit from the dividends those companies pay out?
Absolutely not. You don't own the stocks. You own a shadow. When the physical companies in the S&P 500 pay dividends, real cash goes to the real shareholders. You, holding the derivative, get nothing. However, the physical index itself accounts for the value of those stocks. To make the futures contract mathematically fair compared to choice A, the investor who bought the physical stocks and is collecting those dividends, the pricing model must subtract the value of the dividends you will miss out on. You add the interest you gain, and subtract the dividends you miss.
This formula isn't arbitrary. It's a perfectly balanced scale to prevent risk-free arbitrage. Now, who are the players interacting with these formulas in the real market? The text categorizes market participants into three distinct profiles. First, hedgers.
Hedgers are not looking to get rich quick. They are looking to neutralize existing risk. They already have exposure to the market. For instance, a mutual fund manager holding a massive portfolio of stocks fears an impending economic downturn. They can execute a short sell hedge. By selling index futures, they create a counterbalance. If the market crashes, their physical stock portfolio loses massive value, but their short futures contracts gain massive value, effectively insulating their overall capital.
Or consider the long buy hedge. Imagine a pension fund knows they are receiving a massive influx of cash from contributors in 3 months. They want to invest it in the market, but they are terrified the market will surge 10% before they get the cash. They buy long index futures today. If the market surges, the futures contract makes money, offsetting the higher cost of buying the physical stocks 3 months from now. They use the future to lock in today's price.
The second category of participants is speculators. Unlike hedgers, speculators have no prior underlying cash position to protect. They are stepping into the arena purely to profit from anticipated price movements. They are taking on naked risk.
Now, I want to address the elephant in the room. In mainstream media, speculators are almost uniformly painted as the bad guys. They are the greedy Wall Street gamblers who destabilize markets and cause crashes. Does the academic textbook support that narrative?
Interestingly, the textbook explicitly counters that popular narrative. In financial theory, speculators are considered vital for a healthy, functioning market. Think about the hedger we just discussed, the mutual fund manager trying to offload their risk by selling a future. For them to sell, someone has to be willing to buy. If only hedgers existed, the market would freeze because everyone is trying to offload risk and no one wants to take it.
So speculators are the buyers.
Speculators actively absorb the risk that hedgers are desperate to shed. In doing so, they provide massive liquidity to the market. Furthermore, by aggressively buying when they think prices are too low and selling when they think prices are too high, speculators actually act as a stabilizing force, reducing the overall variability and volatility of prices over time. They are the grease that allows the market engine to turn.
So for a true or false question on the exam, speculators are detrimental to market health. The answer is definitively false. They provide liquidity and absorb risk. The third and final group is the arbitrageurs. These are the mathematical scavengers of the market, hunting for risk-free profit by exploiting temporary pricing inefficiencies.
They operate primarily through two methods. Futures arbitrage occurs when an arbitrager spots a discrepancy in price between two different futures contracts for the same asset, perhaps expiring in different months that shouldn't mathematically exist. They simultaneously buy the undervalued contract and sell the overvalued one, locking in a profit as the prices inevitably converge.
The other method is cash futures arbitrage. This relies on the valuation formula we just discussed. If the actual price of an index future in the market drifts away from its theoretical F sub B value, perhaps due to sudden panic selling, the arbitrager steps in. If the future is trading too cheap relative to the physical stocks, they buy the future and simultaneously short sell the physical stocks. They lock in a guaranteed profit, and their massive trading volume physically forces the two prices back into mathematical alignment. Arbitrageurs are the market's automatic self-correcting mechanism.
Which brings us to the final segment of Chapter 14. We are stepping away from standardized exchanges and moving back into the realm of customized, over-the-counter agreements. We are looking at swaps and swaptions.
The terminology sounds incredibly complex, but the foundational definition is remarkably straightforward. A swap is quite literally an agreement to exchange one stream of cash flows for another stream of cash flows with different characteristics. You aren't exchanging assets, you're swapping payment obligations.
The textbook highlights two dominant types of swaps. Currency swaps, where principal and interest payments in one currency are exchanged for equivalent payments in another currency, primarily used by multinational corporations to safeguard against long-term exchange rate fluctuations, and the much larger market, interest rate swaps.
Interest rate swaps are where one party exchanges a set of fixed interest rate payments for a set of floating or variable interest rate payments. Let's build a concrete scenario to show why this happens.
Good idea.
Imagine two corporations. Corporation A has an excellent credit rating and can borrow money from a bank at a very low fixed interest rate. However, Their business model generates revenue that fluctuates with the market, so they actually prefer a variable rate loan to match their income.
Okay.
Corporation B has a terrible credit rating. Banks will only lend to them at a highly volatile, variable interest rate. But Corporation B's business requires stable, predictable costs, so they desperately need a fixed interest rate.
This is a perfect scenario for an interest rate swap. Corporation A takes out the fixed rate loan they qualify for. Corporation B takes out the variable rate loan they are stuck with. Then they enter into an OTC swap agreement. Corporation A agrees to pay Corporation B's variable interest payments, and in return, Corporation B agrees to pay Corporation A's fixed interest payments.
They don't swap the underlying debt. They still owe their respective banks the principal. They just swap the cash flows of the interest payments. Through financial engineering, both corporations end up with the exact type of interest rate exposure they originally desired. It is a brilliant tool for customizing debt profiles.
The text also briefly mentions other variations, such as credit swaps, commodity swaps, and equity swaps, but interest rate and currency swaps form the vast bulk of the market. But what if a corporate treasurer anticipates needing an interest rate swap in 6 months, but doesn't want to commit to the obligation today?
Well, then you need a swaption. We're officially entering the territory of derivatives on derivatives.
Exactly as the name implies, a swaption is an option granting its owner the right, but not the obligation, to enter into an underlying swap agreement at a specific future date. It requires the payment of an upfront premium.
There are two main mechanics here. A pair swaption gives the buyer the right to enter a swap where they pay the fixed rate and receive the floating rate. This is essentially a put option on bond prices, acting as a hedge against rising interest rates. Conversely, a receiver swaption gives the buyer the right to enter a swap where they receive the fixed rate and pay the floating rate, acting as a hedge against falling interest rates.
It is vital to remember for the exam that the swaption market is entirely over-the-counter. These are not exchange-traded instruments. They are private, customized contracts negotiated directly with major investment banks.
Finally, the textbook provides 3 styles of swaptions, categorized by when the buyer is allowed to exercise their right to enter the swap. First, we have the American style, where the buyer can exercise their right and enter the swap on any single day within a specified range. Total flexibility. Second, we have the European style, where the buyer can only exercise their right on one single specific maturity date.
And third, we have a style unique to this space, the Bermudan swaption.
This is one of my favorite terms in finance, because it provides a perfect geographical mnemonic device for the exam. Look at a map. Geographically, the island of Bermuda is situated in the ocean right between America and Europe. Mathematically, a Bermudan swaption sits right between the American and European rules. You don't have the ultimate freedom to exercise on any day like an American option, and you aren't severely restricted to just one single day like a European option. In a Bermudan swaption, you can exercise your right on certain predefined specific dates within a range. It is middle ground.
It is a highly effective way to remember the distinction.
And with that, we have traversed the entirety of Chapter 14. We have covered a staggering amount of highly technical terrain. Let's pull the camera back and trace the through line of everything we've synthesized today.
Good idea.
We started with the conceptual baseline, understanding a derivative as a financial shadow, fundamentally devoid of intrinsic value, deriving its worth entirely from an underlying asset. We established the crucial difference between market risk, which is massive, and credit risk, which is virtually eliminated on exchanges through the daily enforcement of margin deposits.
We then explored the asymmetrical realm of options. We analyzed the power dynamic of rights without obligations, where buyers limit their risk to an upfront premium, and sellers shoulder open-ended obligations secured by margin deposits. We charted the math of calls and puts, demonstrating how the formulas govern profitability. We explored the 6 parameters of pricing, proving mathematically why volatility is universally favorable to an option buyer, and how the cost of carry dictates the impact of interest rates and dividends.
We tackle the heavy machinery of the pricing models. We debated the frictionless, continuous universe of the Black-Scholes formula and its 7 rigid assumptions. We then contrasted it with the adaptable, step-by-step logic of the binomial tree and its process of backward induction.
From there, we crossed the boundary into the realm of absolute obligations, futures and forwards. We highlighted how the clearinghouse uses the legal magic of novation to sever counterparty risk, and how the grueling daily cycle of mark-to-market settlement is enforced by initial, maintenance, and variation margins.
We examined how index futures are priced to prevent arbitrage by balancing risk-free rates against missed dividends. We defended the economic necessity of speculators as liquidity providers. And finally, we dismantled the mechanics of swaps and swaptions, showing how corporations trade risk profiles by swapping cash flow streams in the over-the-counter market. You now possess a comprehensive structural mastery of the mechanics within this chapter.
You don't just know the definitions. You know why the formulas look the way they do. But before you close your textbook and head into that exam, I want to leave you with the thought that connects this academic material to the very real, sometimes terrifying reality of the global economy.
Oh, this is the systemic risk part.
Yes. Early on, we discussed the concept of gearing the financial lever, where a tiny upfront premium can control a massive quantity of an underlying asset. We celebrated it as a tool for high percentage returns. But consider the macroeconomic implications of a system entirely built on that level of leverage.
Is a house of cards.
It raises a profound question of systemic risk. The total notional value of the global derivatives market is currently estimated to be in the hundreds of trillions of dollars. It is a number so incredibly large it exceeds the gross domestic product of the entire planet by a massive multiple. The shadow is now exponentially larger than the object casting it.
Which is terrifying, honestly.
We have engineered a global financial architecture where these highly geared instruments are intricately woven into the balance sheets of every major bank, corporation, and government. The question to ponder is this: what happens to the structural integrity of the physical market when a sudden, violent shock travels through the infinitely larger, interconnected shadow market? When the margin calls are so massive that the underlying physical assets must be liquidated just to cover the variations? It is a question that moves way beyond the scope of a textbook, straight into the fragile reality of modern systemic stability.
The shadow swallowing the object. It's a sobering thought to mull over during your final study break. But to the MBA student listening to this, staring down the barrel of this exam, you have done the work. You have dismantled the architecture. You understand the rights, the obligations, the math, and the mechanics. Walk into that room with confidence. Remember the rice farmer trying to secure a fair price. Trust your logic, and you're going to absolutely crush it. Thank you for joining us on this deep dive.